Coming out of the last section's data, the first thing to understand is this. This wasn't fundamentals. This was forced behavior. What you witnessed was not a collective market vote. It was a rule-driven move expressing itself through thin liquidity. When rules shift inside a stressed system, price doesn't negotiate. It transmits. That transmission can feel violent, disorienting, even personal. You're not crazy. This is what system stress feels like when invisible layers surface through visible quotes. Beneath every candle is an infrastructure of constraints, permissions, and obligations. That invisible layer is what moved first here. The headlines arrived later. And because liquidity was already thin, a structural impulse didn't disperse, it concentrated. That is why this moment matters psychologically. The next 14 days are not about prediction. They are about decision windows, attention, and behavior. They want nausea, they want reaction. They don't want understanding. The real question remains, what actually happened? If you strip away the emotional noise, what remains is a mechanical sequence. Policy instruments and market instruments do not operate on the same clock, but they intersect through the same plumbing. Executive actions don't touch price directly. They alter permissions, obligations, and compliance conditions. Those changes travel through clearing systems, delivery expectations, and contract language before they ever express themselves on a screen. That transmission layer is where this began. There's a critical distinction here. Industrial allocation controls target functional supply chains. Civilian market flow operates through financial intermediaries, custodians, and exchanges. When administrative signals enter that environment, they don't remove metal from vaults overnight. They change the risk profile of participation. They alter what can be promised, hedged, financed, or delivered. That is enough to trigger behavior. Clearing members, counterparties, and large participants live inside rulebooks. When those rulebooks appear to shift, even slightly, automated systems don't wait for press conferences. They reprice exposure. Compliance risk becomes price risk. That is how administrative shifts turn into liquidity events. Orders don't arrive because someone feels bullish or bearish. They arrive because something has become non-optional. This is why the first movement almost always appears in paper structures. Claims can be repriced instantly. Logistics cannot. Futures, options, and financing vehicles absorb information before warehouses ever move a pallet. In early stages like this, information asymmetry dominates. Some participants must respond regardless of opinion. Others are still interpreting. What matters next is not the headline. It's where the stress migrates when rules change faster than inventory can move. Why it felt violent. From that mechanical chain, the sensation of violence makes more sense. What people label as panic is often the visual artifact of forced selling colliding with thin liquidity. Voluntary sellers wait. Forced sellers act. They don't choose timing, and they don't negotiate levels. They respond to thresholds embedded in margin frameworks, compliance models, and internal risk limits that rarely appear in headlines. When those thresholds are touched, behavior activates automatically, and price becomes the messenger. Thin liquidity magnifies this process. In calm regimes, order books cushion flow. Under policy uncertainty, that depth retracts. Spreads widen, quotes thin, and even modest size can move price farther than intuition expects. That expansion of empty space is what makes motion feel violent. It isn't acceleration of opinion, it's evaporation of buffer. With fewer resting orders willing to absorb flow, every forced transaction carries more impact. Volatility also feeds on itself in these environments. Policy ambiguity increases model error. Model error increases margin sensitivity. Margin sensitivity increases turnover. And turnover, in thin markets, amplifies range. This loop can make hedging flows resemble conviction. Protective adjustments look like directional bets when they cascade across correlated books. What appears to be a rush toward certainty is often a synchronized retreat from uncertainty. This is why the emotional whiplash is so pronounced. Structure creates it. Rapid expansion and contraction of liquidity compress time. Price moves faster than narrative can follow. That mismatch destabilizes perception, and confusion becomes a temporary stabilizer for systems. When participants are disoriented, fewer act by choice, more act by rule. Inside volatility regimes, decision windows narrow. Attention becomes a scarce resource. The critical question shifts away from where price goes and toward which behaviors were automated, and who may become a price taker next. Facts versus interpretation. To navigate this phase without being pulled into narrative gravity, a credibility ladder matters. Fact. Administrative control mechanisms already exist across industrial supply chains. Allocation authorities, priority classifications, and emergency directives are built into the architecture. They are not theoretical. Interpretation. The market's reaction suggests a repricing of compliance risk, not an overnight disappearance of metal. What shifted first was the perceived permission set, not the physical landscape. Fact. Paper volume moved faster than any physical system can. Claims can change hands in milliseconds. Refining, transporting, and certifying material cannot. Interpretation. This was information stress expressing itself through leverage and contracts, not confirmed scarcity working its way through warehouses. Price reflected the speed of documentation, not the speed of trucks. Fact. Volatility clustered around contracts most exposed to rule uncertainty. Options, surfaces distorted. Spreads widened where delivery language matters most. Interpretation. The market repriced optionality, not ounces. It adjusted the cost of flexibility under new administrative ambiguity. This distinction is not semantic. It is stabilizing. Clarity is capital. Separating what is verifiable from what is inferred keeps you anchored while the narrative environment mutates. Facts arrive slowly. Interpretations proliferate instantly. The danger is not that interpretation exists. The danger is mistaking it for structure. Which confirmations are still missing will define the next layer of understanding. And which narratives fail first will quietly reveal which ones were built on air. The decision zone. As this phase unfolds, attention naturally gravitates toward levels. That's understandable. But in structurally driven environments, decision zones are not price targets. They are behavior clusters. They are areas where liquidity thins, rule sensitivity increases, and participants are no longer expressing preference so much as responding to constraint. The importance of these zones isn't where price goes. It's what actors are forced to do when price arrives. This is where rules begin to dominate over narratives. In deep, liquid regions, markets can absorb disagreement. In thin regions, they enforce resolution. That distinction matters now, because what this market requires first is not rebound, it is stabilization. Stabilization allows systems to recalibrate risk models, update compliance interpretations, and test whether recent assumptions still hold. Without stabilization, every movement remains ambiguous. With it, behavior becomes legible. Noise zones are where volatility expresses emotion. Enforcement zones are where volatility expresses obligation. In noise zones, flows are optional. In enforcement zones, flows are conditional. The market is currently negotiating which regions belong to which category under this new informational regime. That negotiation process is the decision zone. This creates a different form of decision window pressure. Early on, participants observe, they map, they reduce exposure to unknowns. Later, they react, they test boundaries, they probe what is permitted, financeable, and deliverable. And those tests are rarely announced. They show up as failed holds, sudden stalls, or rapid retracements. The first failed test often reveals more about structure than any breakout ever could. A real structural shift would not be defined by excitement. It would be defined by changed response, by regions that once absorbed flow now deflecting it, by behavior that once appeared discretionary becoming automatic. The open question isn't which level attracts attention, it's which one forces behavior, and what happens if stabilization itself attracts more rules. Decision zones aren't where price goes, they're where behavior changes. Paper versus physical. As those decision zones form, the most important separation to maintain is between symbolic silver and logistical silver. Paper silver is a claims architecture. It is a network of promises, offsets, financing structures, and optionality. Physical silver is a logistics architecture. It is extraction, refining, certification, transport, fabrication, and end-use demand. They intersect, but they do not move the same way, and they do not absorb stress on the same timeline. Administrative controls primarily enter through the claim side first. They don't immediately empty vaults. They pressure delivery language, financing terms, hedging permissions, and compliance frameworks. That pressure changes expectations about what can be promised, not what currently exists. And when expectations shift, paper structures reprice before physical systems can respond. Futures behavior reflects permission. Premium behavior reflects friction. This is why watching price alone is insufficient. Premiums and availability patterns often whisper before inventories ever speak. Inventory numbers are optics. They are snapshots of registered categories and reporting standards. Movement reality lives elsewhere, in lead times, in substitution behavior, and industrial procurement decisions that don't announce themselves to traders. Industrial pull-through risk rarely shows up first as a shortage. It shows up as altered ordering patterns, altered contract terms, and altered tolerance for delay. Divergence, when it develops, rarely appears at the first shock. The initial impulse is absorbed by claims because claims are elastic. They stretch, they roll, they compress. Logistics are inelastic. They adapt slowly, then suddenly. That is why physical stress often lags the paper event that set it in motion. By the time divergence is visible, the behavioral shift has usually been underway for some time. Which channel reflects stress first is often the one built on speed. Which channel absorbs it last is always the one built on capacity. And the unresolved question now is where the first real bottleneck surfaces when expectations and logistics finally meet. Paper moves on permission, metal moves on capacity. Scenario map, breakout versus fakeout versus washout. With the paper and physical layers separated, the next step is not to forecast an outcome, but to map the system's plausible paths. Scenarios are not predictions. They are structured ways to observe behavior as it unfolds. In this environment, three broad patterns tend to emerge when rule pressure enters a leveraged market: validation, absorption, or cascade. In a breakout-style scenario, the administrative signal is gradually validated through follow-through behavior. Compliance interpretations stabilize, risk models adjust, and price begins to reflect a sustained repricing of permission rather than a one-off shock. Volatility remains elevated but directional. Liquidity rebuilds unevenly. The behavioral signature here is participation. New actors are forced to engage, not by excitement, but by altered constraints. The market doesn't sprint, it grinds. In this case, what matters most is whether stabilization invites more structural volume rather than less. Invalidation would come quickly if volume dries up and volatility collapses without corresponding clarification. In a fake-out style scenario, the initial information shock fails to propagate. Administrative ambiguity resolves in ways that leave existing structures largely intact. Liquidity returns, spreads compress, volatility bleeds off. The behavioral fingerprint is fatigue rather than momentum. Participants who were forced to adjust early find that subsequent flows are optional again. Price may retrace, not because metal appeared, but because risk was reclassified. This scenario punishes immediacy. It rewards patience. It is invalidated when what should have been temporary dislocation begins recruiting new forced participants instead of releasing them. In a washout-style scenario, the first forced wave exposes deeper leverage layers. Margin thresholds trigger secondary behavior. Secondary behavior uncovers tertiary exposures, liquidity fragments. Volatility ceases to be expressive and becomes procedural. The behavioral signature is not trend but turnover, rapid shifts, failed holds, repeated air pockets. This scenario is not loud at the beginning. It becomes loud when participants realize exits are shared. Invalidation here occurs if stress remains contained within a narrow set of instruments rather than migrating across correlated structures. All three scenarios carry decision window pressure. Early phases are observation heavy. Later phases are reaction heavy. What differentiates them is not price height, but behavioral spread. Who is being recruited? Who is being released? Which actions remain optional and which are no longer negotiable? The market will reveal which path is dominant, not through commentary, but through who is forced to act. Which scenario punishes certainty most will become obvious in hindsight. Which one rewards patience will only be visible in real time. And the unresolved question is, which path recruits the largest population of unwilling participants? Scenarios don't predict, they prepare. Risk discipline and positioning mindset. At this stage, the most valuable shift is away from outcome obsession and towards structural observation. Risk discipline, in environments like this, is not primarily about positioning. It is about information hygiene. It is the practice of protecting what enters your decision process, which inputs you allow, which narratives you grant emotional authority, which signals you treat as structural rather than theatrical. Emotional regulation becomes a mechanical advantage under these conditions, not because emotion is wrong, but because systems under stress exploit it. Volatility compresses time. Headlines compete for cognitive priority. Reaction feels productive, but reaction is often what the structure is designed to extract. Calmness slows the feedback loop. Slower loops reveal causality. Faster loops amplify noise. This is why observing who is forced and who is not becomes more important than where price prints. Forced participants leave fingerprints. They transact at inopportune times. They accept unfavorable terms. They cluster around administrative boundaries. Those who can wait behave differently. They provide liquidity instead of demanding it. They adjust processes instead of liquidating exposures. Distinguishing between the two is mechanical literacy. It is the survival skill of stressed markets. Avoiding narrative anchoring is part of that discipline. Stories feel stabilizing when structure is unstable, but stories harden perception, just as conditions are shifting. The system doesn't move on headlines, it moves on constraints. Watching the evolution of those constraints is more informative than consuming interpretations of them. Decision window pressure always targets attention first. What you monitor becomes what you trade emotionally, even if you don't trade financially. That is why the question isn't only what is happening, but which signals deserve weight and which ones are designed to steal it. Every cycle trains behaviors out of participants before it installs new ones. What is being trained out now is immediacy. What replaces it is yet to be visible. Structure rewards the calm long before it rewards the correct. What to watch next? As this system processes the initial shock, the most useful shift is from watching outcomes to watching signals. In rule-driven environments, structure rarely announces itself through price first. It announces itself through behavior. One of the first separations to monitor is between policy clarification and enforcement action. Clarifications soothe narratives. Enforcement reshapes constraints. Markets can ignore language. They cannot ignore procedure. Which one dominates in the coming days will quietly define the operating environment. Spread behavior is another early tell. When stress is structural, it concentrates. Volume stops dispersing evenly and begins clustering around specific instruments, maturities, and venues. Watch where activity thickens, not where it spikes. Clusters reveal where rules, risk models, and balance sheets intersect. Is flow migrating toward instruments with flexible delivery terms or away from them? Is volatility broadening or becoming selective? These patterns often speak before commentary does. Delivery data and headline cadence should also be separated. Headlines arrive on human schedules. Logistics operate on industrial ones. When delivery-related disclosures, delays, or procedural adjustments begin to appear independent of media rhythm, that divergence matters. Inventory numbers alone are not movement. Reporting changes are not withdrawals. What carries signal is inconsistency between categories, revisions, and the quiet alteration of how figures are framed. Options skew and the shape of volatility offer another window into structural expectation. Skew reflects where protection is being demanded, not what stories are being told. Shape reflects whether uncertainty is localized or systemic. Those curves often register institutional discomfort before it becomes visible anywhere else. The next 14 days are best understood as an information sorting phase. Early misclassifications are corrected. Risk models are rewritten. Compliance interpretations stabilize. Somewhere inside that process, the first secondary rupture may appear, not necessarily in price, but in correlation. Which signal leads, structure rather than price, will only be obvious after it passes. What silence would matter most is the kind that follows expected data, not the kind that precedes headlines. Signals whisper before outcomes speak. Structural context layer. Where this fits in the bigger system. To understand what this moment represents, it has to be placed inside the larger architecture that governs materials, not markets. Industrial metals are not merely traded assets. They are strategic infrastructure. They sit inside energy systems, defense systems, technological systems, and manufacturing systems. That positioning changes how stress propagates. When volatility touches industrial inputs, it doesn't remain financial. It migrates into planning, procurement, and policy. Administrative reach functions today less as episodic intervention and more as continuous supply chain governance. Modern systems are too interconnected to be managed only through price. They are managed through standards, classifications, permissions, reporting obligations, and emergency authorities that already exist before any announcement is made. Under normal conditions, those layers remain invisible. Under stress, they surface. And when they surface, they don't announce new control. They reveal old architecture. This is where the distinction between monetary metals and functional metals becomes operationally relevant. Monetary metals primarily sit inside confidence systems. Functional metals sit inside production systems. Silver occupies a boundary position. It is treated symbolically in some channels and logistically in others. That dual identity means stress can enter from either side. Financial instability can reach industry. Industrial prioritization can reach finance. The system doesn't have to choose. It transmits both. Historically, control layers expand not because of ideology, but because of coordination demands. Stress compresses tolerance for decentralization. It increases the value of predictability, traceability, and assured access. That pressure doesn't remain isolated. Once applied to one material stream, it tends to migrate across adjacent commodities that share logistics, refining capacity, or strategic relevance. Structural pressure rarely respects ticker symbols. Inside this expansion sits what can be called compliance economics, the invisible layer where value is influenced not by scarcity alone, but by permission, classification, and procedural friction. Who can source? Who can store? Who can transport? Who can finance? Those questions quietly reshape incentives long before any shortage narrative becomes public. The open uncertainty is not whether systems will adapt, but which ones adapt slowest. Where control meets logistics is where delays accumulate. Which sector resists longest often determines where stress ultimately settles. Control doesn't replace markets, it redirects them. Historical and pattern echo. When the system last behaved like this. Situations like this feel unprecedented, largely because novelty bias is one of the system's most reliable distortions. But when you widen the frame, the behavioral pattern is familiar. Periods of industrial allocation, wartime prioritization, and emergency material controls have appeared repeatedly across the last century, not always with the same language, not always with the same legal form, but with the same structural logic. When materials intersect national capability, coordination replaces price as the primary organizing force. In those earlier phases, markets did not disappear. They reorganized. Optionality was repriced before scarcity was confirmed. Permissions mattered more than possession. Contracts became riskier than inventories. What moved first was not metal. It was the confidence structure around delivery, substitution, and access. Paper claims adjusted rapidly. Physical systems adjusted slowly. That lag created the first visible gaps, not because warehouses were empty, but because expectations had fractured. Psychologically, the similarities are striking. Sudden narrative overload, competing authorities, rapid swings between reassurance and alarm. Participants mistook administrative shifts for supply events and supply delays for price signals. Emotional whiplash was not a side effect. It was the environment. People felt markets were unstable when, in fact, the rules governing them were being reinterpreted in real time. History also suggests something about time frames. These transitions rarely resolve inside a single news cycle. They unfold in stages: initial shock, partial retracement, procedural clarification, secondary stress. Only later does the full economic footprint become visible. The most consequential changes tend to occur after attention has already moved on, when systems quietly rewrite how materials are classified, financed, and prioritized. Misread outcomes are common because observers focus on price arcs rather than process shifts. The longest to surface are usually the behavioral changes embedded into procurement, inventory strategy, and cross-border logistics. Which historical outcomes were misread most often were the ones judged too quickly. Which took longest to surface were the ones embedded deepest into industrial routines. The system remembers stress even when people don't. System map and long-range implications. What this unlocks going forward. Once a rule layer becomes visible, it doesn't simply fade back into the background. It becomes precedent. And precedent is one of the most powerful forces inside complex systems. Administrative actions don't only solve for the present condition. They quietly rewrite the range of acceptable future responses. That creates what can be called administrative precedent risk, where participants must now account not only for markets, but for the growing probability that allocation, prioritization, and classification tools will be used again. This alters incentive structures across industries. Procurement strategies shift from cost optimization toward access assurance. Financing models begin to price procedural stability alongside price volatility. They appear as efficiency initiatives, resilience programs, and compliance upgrades. But together, they redesign how materials are valued inside corporate planning. Capital also responds to these shifts in subtle ways. When rule layers thicken, capital tends to rotate away from environments where permissions are ambiguous and toward those where frameworks feel more legible. This does not always mean less risk. It often means different risk. Structural volatility regimes emerge where price is no longer the sole expression of uncertainty. Access, documentation, and jurisdiction become volatility inputs. Markets that once moved primarily on supply and demand begin to move on interpretation and enforcement. Over time, this environment erodes trust in purely symbolic claims. Not suddenly, gradually. Participants begin to assign more weight to structures that sit closer to function than to abstraction. That does not remove paper markets. It changes how they are used, as tools, not as proxies, as hedges, not as stand-ins. This shift rarely produces dramatic announcements. It produces quiet reallocations. This is why long-range implications are better described as opportunity leakage rather than opportunity revelation. New behaviors seep into standard practice. New constraints are normalized. New frictions become embedded. By the time they are visible, they are already priced into process. The unanswered question is, which architecture changes next? Which market adapts first? Which one fractures? Those answers won't come from commentary. They will come from procedural revisions, contract redesigns, and altered participation patterns. When structure shifts, opportunity doesn't announce itself. It leaks. Power shift and behavioral rotation. Who is being forced to change? When structure shifts, power rarely announces itself. It redistributes through obligation. In this phase, the most important developments are not who is speaking, but who is being forced to adjust their operating assumptions. Industrial consumers sit closest to that pressure. Allocation risk changes how they plan, how they hedge, how they negotiate contracts, and how they tolerate delay. When access becomes conditional, procurement stops being a cost function and becomes a continuity function. That alone forces behavioral rotation long before any shortage narrative becomes visible. Financial intermediaries face a different form of compulsion. Compliance expansion doesn't just add paperwork. It alters balance sheet treatment, counterparty tolerance, and the internal definition of acceptable exposure. Risk departments become more influential than trading desks. Documentation begins to matter as much as direction. In those environments, institutions that once facilitated flow may quietly narrow it, not as a statement, but as a survival response. Retail psychology is pressured from the opposite direction. Narrative saturation increases, conflicting interpretations multiply. Certainty is marketed aggressively because attention is scarce. This doesn't empower individuals, it exhausts them. Emotional fatigue becomes a form of risk. When fatigue sets in, behavior polarizes. Some disengage, some overcommit. Both are structural outcomes, not personal failures. Inside that environment, roles begin to invert. Some participants become price takers, not because they are uninformed, but because their constraints tighten. They must transact when conditions present, not when conditions are ideal. Others become risk managers by necessity. Their advantage is not foresight, it is flexibility. They adapt processes rather than positions. They redesign exposure instead of defending it. Behavioral migration follows, capital shifts venues. Activity concentrates in instruments with procedural clarity. Participation declines where rule ambiguity is highest. Over time, this reorders influence. The actors who can translate administrative signals into operational adjustments gain quiet leverage. Those who depend on narrative stability lose it. The unanswered question is not who will speak loudest, but who will exit silently. Which roles shrink? Which ones multiply? Those transitions rarely trend, they seep. Power shifts are quiet. Behavior tells the story. Second-order effects. What this will break next. First-order moves shock perception. Second-order moves reshape systems. Once the initial impulse has passed through price, the more durable pressure begins working its way into architecture. Contract design is often one of the first stress points. Language that once functioned as boilerplate becomes active terrain. Delivery clauses, force majeure conditions, substitution rights, and settlement alternatives are suddenly reread not as legal formalities, but as risk instruments. That rereading process rarely makes headlines, but it changes how future agreements are written, priced, and enforced. Insurance and hedging structures follow closely behind. Models built for supply volatility behave differently under permission volatility. When access, classification, or compliance becomes uncertain, traditional hedges can distort rather than protect. Premiums drift, coverage exclusions expand, basis risk grows. Instruments that once reduced exposure begin to introduce it. Over time, this alters what protection even means inside industrial and financial systems. Industrial procurement then absorbs those distortions. Procurement timelines lengthen. Vendor concentration becomes visible. Inventory strategies shift from efficiency toward redundancy. Procurement officers begin valuing contractual reliability over marginal price improvement. These are not reactions to a chart. They are adaptations to procedural instability. And because they occur inside corporate processes, they propagate slowly, then persistently. Reporting standards also feel quiet pressure. Categories are revised, definitions are tightened, disclosure language becomes more conditional. What was once treated as interchangeable inventory becomes segmented. Those changes don't remove material from the system, but they change how it is counted, financed, and mobilized. And when reporting frameworks shift, correlations often follow. Correlation regimes are rarely broken by price alone. They fracture when the assumptions linking markets stop applying. If one material stream becomes administratively sensitive, adjacent ones often inherit that sensitivity through shared logistics, refining capacity, or regulatory treatment. The first non-silver casualty may not be a metal at all. It may be a financing structure, a derivative convention, or an industrial input whose stability was assumed rather than tested. Alongside these mechanical changes runs a psychological one. Participants carry stress forward. Decision fatigue accumulates. Reaction thresholds lower. Over time, this alters liquidity provision itself. Markets don't just move differently, they feel different to operate within. Which adjacent market absorbs shock first will be clearer later. What breaks slowly, not loudly, will matter more. First order moves scare, second order moves change. Control layer in market psychology. How this phase trains the crowd. Every volatility regime conditions behavior long before it resolves outcomes. Over time, people don't just learn what moves, they learn how to feel while it moves. That conditioning is not accidental. It is a functional layer of the system. Repeated uncertainty trains faster reactions, shorter attention spans, and lower tolerance for ambiguity. Confusion becomes not a side effect, but a preparation phase. When participants are cognitively overloaded, they default to the most available narrative, the most recent price, the loudest interpretation. That is not weakness. It is how human perception conserves energy under stress. Complexity plays a role here. Dense language, procedural detail, and fragmented signals don't only reflect reality, they also camouflage it. Institutional systems operate most efficiently when comprehension lags mechanics, when people track outcomes instead of processes, when they respond to volatility instead of interrogating its source. In that environment, mechanical literacy becomes a form of quiet defense. Understanding how rules, leverage, and permissions express themselves through price reduces the need for emotional certainty. Attention, in these phases, is the most actively competed for resource. What you watch shapes what you internalize. What you internalize shapes what you feel pressured to do. Building non-reactivity is not passive. It is an active refusal to let the system dictate your cognitive tempo. Slowing perception creates space for structure to become visible, and structure, once seen, is less destabilizing. This is why it matters to ask yourself what signals you're personally watching right now. Not what opinions you're hearing, but what behaviors you're observing, and whether what you're seeing around physical availability, premiums, and delivery feels different locally, or whether the stress you're encountering exists only at the headline level. If these briefings are useful, it's because continuity matters in environments like this. Systems reveal themselves through sequence, not snapshots. And sequence requires a stable analytical thread to follow it. What sits ahead is not simply another price phase. It is likely another rule layer, another procedural clarification, another subtle shift in what is permitted, financed, or prioritized. Those changes rarely announce themselves dramatically. They surface quietly, inside forms, contracts, and operating assumptions. The open question is what behavior is being trained out of you in this phase, and what replaces it. Every cycle rewires behavior before it reprices assets. Micro-close. Moments like this are better understood as structural events, not narrative ones. Stories rise and fall quickly, but structure moves slowly and leaves marks that persist. What is unfolding now is not a finished chapter. It is an adjustment process. And processes change shape as new rules surface, interpretations harden, and incentives quietly realign. Uncertainty is not a flaw in this phase. It is a feature of systems that are still rewriting their boundaries. And if one more rule shifts while price stabilizes, the next move may be faster than the last.